we gotta talk about what's been going on in this housing market lately. Let's start with the interest rates. All right, so about 9 to 10 months ago, you could have got a 30-year fixed mortgage for about 3.5%. Your monthly payment on a $350,000 home with 4% down, minus property taxes and insurance, would have been about $1,500. All right, and then we fast forward to today, where interest rates are about 7%. That's double of where they were 9 to 10 months ago. That same house, $350,000 house, 4% down. Your monthly payment is going to be about $700 more. You're probably curious what caused all this to happen, right? Well, if you've been listening in or paying attention to CNBC or other finance platforms, then you've probably heard about how the Fed chair has been raising federal interest rates to fight inflation. And you've probably heard people say that the federal interest rate has nothing to do with mortgage rates. But when you look at it a little closer, kinda has a trickle-down effect. Here it says when the federal funds rate increases, it becomes more expensive for banks to borrow from other banks. Those higher costs may be passed on to consumers in the form of higher interest rates on lines of credit, auto loans, and to some extent, mortgages. And in terms of inflation, here it says housing represents about a third of the value when it comes to the basket of goods and services that BLS uses to track inflation. A rise in the price of shelter, which is what the BLS uses to label housing, contributed to an increase in inflation earlier this year. Here's what Mr. Powell says about inflation.
Reducing inflation is likely to require a sustained period of below-trend growth. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.